We are going to move from a resilience to a natural brilliant state.
We're all here to move our Black communities forward.
We think our children have to have the best. It's all about discipline.
How are we going to discipline ourselves so that we're able to save, so that we're able to make good financial decisions?
Recognizing that there's a road ahead if you manage the road in front of you.
The decisions that you're going to be making today in your lives where it comes to money will affect you in the future.
Discipline is one of the things that we often learn, sometimes by our environment, or sometimes we're forced to do it, and sometimes we don't learn it at all.
Stores want to get us in and out and get our money, and that's it. It's a game, so you have to be really wise to the game.
Do you know what it costs to run your home on a monthly basis?
Land acknowledgement. As we gather together, we acknowledge the sacred land on which we reside. It has been a site of human activity for 15,000 years. This land is the territory of the Huron-Wendat and Petun First Nations, the Seneca, and most recently, the Mississaugas of the Credit River. The territory was the subject of Dish with One Spoon Wampum Belt Covenant, an agreement between the Iroquois Confederacy and Confederacy of the Ojibwe and allied nations to peaceably share and care for the resources around the Great Lakes. Today, this gathering place is still the home of many Indigenous people from across Turtle Island, and we are grateful to have the opportunity to work in the community on this territory. We are also mindful of broken covenants and the need to strive to make right with all our relations. Last but certainly not least, we acknowledge the people of African descent who were brought here against their own will or in search of a safe place to live their lives and raise their children. Reconnaissance des terres. En nous rassemblant, nous reconnaissons la terre sacrée sur laquelle nous résidons. C'est un site d'activité humaine depuis 15 000 ans. Cette terre est le territoire des Premières Nations Huron-Wendat et Petun, les Séniques et plus récemment les Mississaugas de la rivière Crédit. Le territoire était sujet de l'alliance de la ceinture Wampum plat avec cuillère, un accord entre la Confédération Iroquois et Confédération des Ojibwe et des nations alliées à partager et à prendre soin pacifiquement des ressources des Grands Lacs. Puis, ce lieu de rassemblement est toujours le foyer de nombreux peuples autochtones de toute l'île de la Tortue et nous sommes reconnaissants d'avoir la possibilité de travailler dans la communauté sur ce territoire. Nous sommes également conscients des alliances brisées et de la nécessité de nous efforcer de guérir toutes nos relations. Dernier point, mais non le moindre, nous remercions les personnes d'ascendance africaine qui ont été amenées ici contre leur volonté ou à la recherche d'un endroit sûr où vivre leur vie et élever leurs enfants.
This webinar provides illustrative information with respect to the subject matter covered and does not represent an official opinion or position of the Black Business and Professional Association. The BBPA makes no representations, warranties, or guarantees as to assume no responsibility for the content or application of the material contained herein, and especially disclaim all liability for any damages arising out of the use or reference to or lines on such material.
Good morning, good morning. It's a beautiful Saturday here in the GTA. The sun is shining and we are so happy and honored to have you with us. It's another session of Community Space, the financial literacy program that speaks the language of the community. And we always say to tell a friend, it's not too late to join us right now. And we're going to be speaking on inflation this morning, something that is here with us at this point in time. And a couple quotes: inflation is taxation without legislation. Very, very true at this point in time. And I like this one here also. Inflation is like alcohol. the good effects come first, and you know what comes after, the headaches. So we got a professional to speak with us this morning as a guest, and her name is Nadine Thompson. Good morning, Nadine. How are you?
Good morning, Roderick. I'm doing very well. Thank you very much. And good morning, everyone.
Great to see you again. And Nadine, you work within the financial literacy space. You do this in terms of edifying community. Tell us a little bit about what we're going to be talking about today.
Well, we're going to just talk about inflation, the basics of it, understanding it. How can we, now that we would have gotten a good understanding of what it is, what are the drivers that inform that number that we hear quoted every month, how can we be proactive in our response in our daily lives, in our business? So that's the overall objective of this presentation series.
All right. And for those who don't know or hadn't heard Nadine Thompson speak, tell us a little bit about what you've done, especially back home in Jamaica, and some of those positions that you've held to qualify you in terms of being able to speak so candidly about inflation and financial literacy.
Well, most of my career was actually within the central bank, the Bank of Jamaica, working as an economist. And as you may be aware, that the role of a central bank is to ensure stable prices within an economy. So the work that I did informed monetary policy decisions so that we could actually have stable prices within the economy. So yeah, that's my role as an economist in Jamaica. And then I had the opportunity to work as an economist with the International Monetary Fund as well. And I still work as an economist now, but in the capacity of liquidity risk management at
All right. Excellent, excellent. So yeah, we definitely look forward to learning a little bit about inflation, something that we just can't get out of absolutely right now. And for those of you joining us here, if you've got any questions for Nadine, we definitely will have some time for you to ask those questions, and also put them in the chat. Chime in on the chat, join the conversation. We want to hear from you, and we build capacity that way. So without further ado, Nadine, we're passing it on to you.
Thank you very much, Roderick. So I'm going to share my screen now. You can let me know when you're seeing my screen.
Yeah, seeing your screen. I guess you could just put it there on the, there we go.
Okay, all right, great. All right, so this is a 2-week series on proactively navigating the high inflationary environment that it's not unique to Canada, but it's, as we can see, like every country across the globe is being adversely impacted by this very high inflationary environment. And so today we're looking at inflation, the good, the bad, and the ugly, and inflation management in terms of how fiscal and monetary policies play a role in ensuring that we have stable prices within the economy. And then next week, we're going to look at risk and cash flow management in a high inflationary environment. So that is, how can we respond in a proactive manner so that we're not just experiencing the negatives, from this high inflationary environment, but how can we position ourselves to be in an advantageous position? So inflation, the good, the bad, and the ugly. So what is inflation? Well, a simple definition is it's a sustained increase in the overall prices in an economy over a period of time. And I don't know about you guys, but when I was like my early days in school, a simple definition was too much money chasing too few goods and services. So if you could just remember anything, inflation is caused by you have too much money in the system, and because people have so much money in the system and you only have these very few goods that's there available, then you have people who are going after it and then they're bidding up the prices. So that's just a simple way of describing what inflation is. And inflation is measured using the consumer price index. So I should note that there are other measures of inflation. For example, you have like a producer price index. So that's more so where in terms of, it looks at the cost that manufacturers and producers face. But the inflation that's usually quoted, it's the consumer price index because it affects like everybody. And inflation is reported as headline inflation and core inflation. And the difference between headline inflation, the headline inflation captures every single, the price of every single item in that CPI basket of goods. And then you have the core inflation, which says, okay, you have things like energy and food, and these tend to really, they can be very volatile. And so, they can drive up the inflation numbers. So what does it look like without these two items? So one of the things that I just wanted to show is just a snapshot of the trends in inflation. And you can see how for most of the period, especially like starting from within like 2015, it has been within the band. So this is a chart that was taken from the Bank of Canada. And you can see where the Bank of Canada, they normally target a 2% inflation rate, but they think that, okay, a band of between 1 to 3% is usually good. And so, but you have seen where since 2021, the prices have gone outside of this band. And so hence why we're experiencing all these higher food prices, energy prices. And so, and hence why the central bank is proactively and aggressively trying to ensure that they get inflation back within this range. And so this is just core inflation. This is when you take out the food and the energy prices, and you'll see that is actually much lower. So before, if you were looking at March, it was 6.7%, and here you're looking more below 4.5% when you take out food and energy. So what are the sources and the drivers of inflation? So we hear about the tightness in terms of the supply chain. We hear about the war in Ukraine, and we also hear about that great resignation, where you have like a lot of people who are out, are no longer in the workforce, and so we have this crunch. So what are the main drivers? It actually comes back down to demand and supply. So one, you have demand, what we call demand pull inflation, and that's where you have demand for goods and services, they exceed the production capacity. So if we were to go back to that picture where you saw like the money chasing the goods, it's like you have a lot of people with a lot of money, and they only have very few goods to meet all of that need. And so hence people are going to bid up the prices because in order, for example, just look at even when, like with respect to housing, we have in Canada a housing shortage, and people are bidding up the price of houses. So you are going to see, like we have been seeing where house prices have been, like in terms of sold at say 200,000 over asking, and that's the same thing. You have these people with a lot of money, and you have, relative to the demand, the supply is not able to meet it. And then you also have cost push inflation. So this affects more the supply side of the economy. So and that is where we are talking about now the supply chain issues that are being factored in. We're factoring in the oil, the supply of oil and energy. And so this is where now the production cost is actually increasing. And so what happens? A producer is not going to necessarily incur all of that cost. They're going to want to pass it on to the consumers. And then now we have built-in inflation. That is when price rises and wage rises too in order to maintain standard of living. So we have seen, for example, a number of banks, including RBC, they have decided that they're going to increase the salary of a number of employees, so that these employees who are actually more disadvantaged because of this very high inflationary environment, they're able to maintain their standard of living. So one benefit coming from inflation is that you may get a higher wage. But the thing about it is that a lot of times the increase that we see in salaries, it does not necessarily equate to the magnitude of increase in price that we see in the economy. And this is just a chart or two charts of the demand and supply. So aggregate demand versus aggregate supply. So aggregate demand speaks about it refers to all of the expenditure in the economy. So it's from a consumer level, from an investment level, from a government spending level, even or net export. So all of those expenses in our economy. And so you're seeing where in the case of you have inflationary pressures where there's an increase in demand. So you're moving from AD0 to AD1, and this is the supply. You realize the supply is constant. And so this is your short run supply. And so what happens? You end up with prices going up. So this really explains what we're seeing in the economy from a demand perspective. Because remember, during the period of COVID, a lot of people weren't spending. And now that restrictions have eased and people are going out and they're eating and they're traveling, then you see an increase in the demand. We normally, in economics term, we say a shift in the demand curve. And this is the short run supply curve. This is a long run supply curve. So here you have real GDP, which is like the growth in the economy. So the long run supply, this is really where your economy would end up being like at full employment. So that means all the resources in the economy would have been utilized. So here you can see this is the original equilibrium where demand meets supply, but then when it increases, this is a new equilibrium.
Could you just explain equilibrium for those people who may not be familiar with that term?
Okay, so equilibrium is that point where demand equals supply. So there's always a price to obtain a good. So it just means that I may not be able to obtain that good based on the price. And so my equilibrium is actually right here. But then when the demand, because other people come in now and they're bidding for the same good, they have outbid me. So take for instance with a house. So this would have been my equilibrium, but this is not my equilibrium because I can't afford it here. This is actually the equilibrium of somebody else in the economy who is able to afford that. So that's where your demand equals supply. And so that is why in economics, we always say the market will always clear because it always clears at a price. The price may not be one where I am able to afford it, but somebody else will be able to afford it. All right. And this is just the flip side where you actually have a contraction in supply. So this graph more explains the supply chain issues that we're seeing in the economy and just globally. So you have, for example, we're holding demand constant, aggregate demand constant, and we're saying because of the contraction in supply, so like manufacturers, they're not able to produce as much. Now you have a contraction, which is actually a movement towards the left. So this actually results in a new equilibrium at a higher price. So hence why we're seeing the higher prices in the economy. All right. So how is inflation measured? So you have a CPI basket that's used, which is an international standard. And there are 8 major categories that are considered. So it's food, shelter, transportation, household expenses, apparel, medical and personal care, sports, and alcohol, tobacco, and recreational cannabis. So now that cannabis is legal, it actually makes the basket. But what is very important to note is that this basket may not necessarily be representative of every single household within the Canadian economy. And so what it does is it just represents the average basket of goods consumed by Canadian households. And so CPI is not a perfect measure of the prices within the economy, but it's actually the best measure that we have to date. And so from a Canadian perspective, in this basket of goods, there's actually a weighting in terms of that these goods have within this basket. And so based on these weights, they'll impact the overall inflation number that we hear quoted by Statistics Canada. So here you can see in terms of the items that have high weighting in the CPI basket, you have food, shelter, you also have transportation and household expenses along with recreational education. So these are very highly weighted measures or components in the basket that can actually skew inflation. So for example, you are seeing in terms of transportation, it accounts for 19.7%, all right? And so with fuel costs increasing, where you can expect that this is actually going to be a driver of higher inflation. In terms of the housing market, where we've seen where housing prices have really skyrocketed, this is a reason why when the inflation numbers are quoted and you hear they talk about what are the drivers, this is a reason because one is the weight that it contributes to the overall basket, but also in terms of the magnitude of the movement that we have been seeing within the economy. And so this is just a look at the numbers to see, okay, what really, these inflation numbers look like. So here, the base year that's used is 2002. So this is like the benchmark year where we're comparing prices to. And so based on the latest available inflation numbers that we have, you can see the overall inflation was 6.7%. Of that, what really contributed to that inflation number? You're seeing that. So another thing that I should note is that when we're looking at and when the inflation number that's quoted most of the times that we reference is the year over year. So you're looking at March 22 numbers relative to March 2021 numbers. All right. So this change, that year over year change you're seeing, is actually the index for these relative to these numbers here. So you're seeing here that the main driver, you have gasoline, that accounted for 40% of the 6.7. Then you have energy, all right? And then you have this 11.2%, which is transportation. So you see everything is pointing to what we're seeing in terms of the crisis in the oil market with higher oil prices. And so I hope you're able to fully understand how the numbers are, the numbers that underlie the inflation figure that's actually referenced every month. And so it will also help you to make better and more informed decisions with your spending and even investment. Yes, Roger?
So I'm gonna spark it off, right? And you can obviously inform me if this is something that is even possible. So isn't it beneficial for the producers, let's say oil companies, to have higher inflation because obviously they profit more? That's
Yeah,
my first question.
that's the thing. It's like a zero-sum game where you have one person who is losing and my loss is actually somebody else's gain.
Right.
So for them, inflation is beneficial as long as the gain that they get from it is actually, it outweighs the cost.
Right.
And a lot of these costs that they would have incurred, they would have incurred them in the past already. All right. So it's not like, for example, the investment that they would have placed to drill the oil and to do the mining, all of those are like costs that would have incurred before. So right now they would really be benefiting.
Absolutely, and then that's my next point because, how did it come about in the sense of, like, for instance, the drill, right? Did the drill bits get more expensive, or did the land all of a sudden say it needs more money to have it being drilled, right? I mean, I think there's a lot of manipulation that happens from the corporate structures that are obviously being able to provide these services for the consumer, right? And is it really a crisis? Because again, has the person power changed in the sense of during the pandemic, for instance, like oil was still needed from everybody, and even if as many people weren't driving, but there was still obviously the supply. The supply didn't change technically, from what I understand, right?
Yeah, but the demand for it changed. So the demand for oil changed. So prior to the war in Ukraine, the demand would have increased because now you have more people they're going out. For one, you have people who were working fully at home. Now they're going back into the office, so they're now driving. And people who are going elsewhere, going to dine, whatever, eat out. So, but then now added to that, all right, you have a curtailment in the supply of oil because of the war in Ukraine. Because Russia, as you know, is a major supply of oil. And so with that source being reduced, you're going to actually, against this much higher demand, which is still increasing, then you're going to end up with an inflationary environment. Because it's not like you have OPEC, which is that body which makes, the producers of oil, the major producers of oil.
Right.
It's not like they're coming out to say, oh, we're going to increase the production of oil. They're not doing that. Because why would they do that? Because it's not beneficial to them. It's definitely not beneficial, because now they can actually, why would I, unless it's like really like an altruistic action. But right now for them it is beneficial. And another thing is that they would have experienced some amount of I'm not sure if it's losses, but decline in terms of their revenue due to the impact of COVID and all of the lockdown. So they are now in a position where they're trying to recoup. So for them, even if, for example, say Saudi Arabia is able to increase their production of oil, they may not necessarily do that because in terms of their targets, it's just not beneficial.
All right, so folks, I hope you're hearing that, because we read between the lines. It sounds like corporate or these major what's the word I know from university now. These multinational corporations are actually driving the prices. It sounds like that to me because, again, if the production can be changed, that can also impact the price at the pumps. Let's use for gas as an example. Then I guess their unwillingness to want to change those prices to help the consumer out at the end of the day.
Yeah.
All right. Well,
Okay, so this is just another view. This is just a 12-month change. So Statistics Canada, they introduced this new CPI, which excludes gasoline only. So before, when we spoke about core inflation, where food and gasoline, that's excluded. Now we're looking at where gasoline is excluded. And so you can see the impact when you, on your CPI, when you exclude the price of gas, your inflation is actually much lower relative to what it is today. So just to go back to the discussion, if the oil producers decide that they're going to ramp up production and increase the supply in light of the shortage that's happening right now, especially from Russia, given that we're not really accepting oil from Russia now, like most countries, then you'd actually see something that looks more like this. And this is just another view. If you own a restaurant, you love to eat out, this is just another view to show how food prices have escalated to really high levels over this 12-month period. So even that is why when we go to the supermarket and we like, how come I just buy this and I pay so much money, So it's like, we can see it, it's in the numbers, because look at it, March 2021, we're looking at 1.3%. Now look at March 2022. So now we see why. And it all comes back down to the basics of demand and supply. So, even though like for some goods that we can't do without, like food, producers are, even if there were still, even say the price increase that they experienced for the input that goes into their production isn't as great, they still have an opportunity where they can really make a better margin in light of the relatively lower supply compared to demand. And so inflation, the good. So when we think about inflation and we hear about it, a lot of times we're only thinking about the negatives. And we're like, oh, well, one, it reduces your purchasing power, but there's also a good side to it, because then without inflation, you won't have like growth in your economy. You won't have increase in your increases or growth in your investment portfolios. Even in your wage, you won't have an increase. And so inflation is necessary to grow an economy, but the problem is it's the high unsustainable inflation that's a problem, and that's where it gets really ugly and it's really bad. So when is inflation bad and ugly? Well, when it's very persistent, because the value of your currency actually declines. So you talk about the appreciation versus the depreciation of your currency. For example, the US dollar is much more stronger, is stronger than the Canadian dollar. But say, for instance, or inflation is so much higher than that in the US, and it persists for a longer time, then we can expect that the value of the Canadian dollar will not worth as much as it used to before. And then, so it erodes our purchasing power and the real rate of return on any savings and investment. Just think about it. You place your money in a savings account and you're getting 3% return on your savings account, and inflation is at 6.7%. Just think about it. You're getting a negative 3.7 return on your investment. So that can't really buy anything, because you're not really getting anything on it. It just makes sense that you had already spent that money many months ago where it had greater value and it could actually buy you more things than you were able to do today. But that doesn't necessarily mean that you should take your money and go and spend it right now. So because inflation is high now, but the expectation is that it will actually come back down in light of the different policy measures that are being put in place. And so another thing is that it impedes business planning and growth, because if your inflation rate is just going up every single month, as a business, you can't really plan. And without a business being able to plan, they can't grow. And if they cannot grow, then they cannot employ people. And if they cannot employ people, then people won't have money to be able to spend in the economy. And so it's like a cycle. And so that is why it's so important for inflation to remain moderately low and stable. And then you also have the issue of hyperinflation. That's where they just run away, just gone out of control. And that's where, like, when countries experience that, they just abandon their currency because it just doesn't make any sense, because the money has no value. And you can also have stagflation. So you have high inflation, low economic growth, and maybe you have heard people discuss it in the news, but that's a potential risk that's on the horizon right now, where you have the high inflationary environment and the low economic growth, and then you have unemployment, which is like we call it increased unemployment. So not total unemployment, and just overall economic uncertainty. And the other thing is that looking internationally, if, for example, you export, your level of competitiveness would have declined because, one, your currency isn't as strong as before, and the other part is that the inputs that you use to produce your outputs, they're much higher, so you have to sell at a higher rate. And when you sell at a higher rate relative to your competitors, people are not going to really buy your product. You're not going to be really competitive. So that's an adverse effect from inflation. And when you think about domestic and foreign investment, well, nobody really wants to invest in a country where the inflation is so high, because what's the sense in terms of the return? It's not going to really make great sense. And so that's also a negative. And then you also have, this is actually an indirect impact, is the redistribution of wealth. So as we spoke earlier, that in high inflation, well, the people who are low income earners, they're more adversely impacted by inflation. And it's just a zero-sum game where one person's loss is another person's gain. And so who tends to benefit in a high inflationary environment? The haves, the people who are in a better position to weather high inflationary environment, the producers, certain businesses that are actually that thrive in a high inflationary environment, they tend to benefit. And so that's another issue. And that's especially against the fact that wage growth in a high inflationary environment is actually very sticky, which means it doesn't increase easily. Wages don't increase as quickly as the prices in other prices of goods, services in an economy. And so you can understand why you will end up with this redistribution of wealth and increased income inequality.
So another little quick question, and folks, if you've got questions for Nadine as she's going through, please do pose them in the chat or come and join us live. So you mentioned, I guess, fixing the curb of inflation, and I guess that would be from a government standpoint, correct?
Correct.
Right.
Yeah.
So how then is that possible? Is that the government could come and fix the curb, and then obviously the producers or the multinationals will have to adjust pricing? Is that am I on the right level there?
So you're preempting my
Okay, all right.
So almost there.
All right.
And by government I mean inclusive of the central bank.
Okay, all right. I'll let you speak on that. Yeah, because
Yeah.
my mind is going a million miles a minute right now, just
Sure.
based on trying to see then how is this like the prices won't? Anyways, I'll let you speak on that.
Yes. So this is a case where inflation, really high inflation hit really real and bad. So Zimbabwe. I don't know if anybody in the chat, in the room, you're aware of Zimbabwe's case where they had really, really high inflation. And so in 2008, you actually had, just imagine this $100 billion bill. Just think about that. All right. And they also had a $1 trillion bill. I'm like, that's like so crazy. So, so over the period of 2008 to 2009, they had hyperinflation. That's where we talk about runaway inflation and you just abandon the currency. So at one point at its height, just think about it. If you wanted $1 US, how much Zimbabwe dollar you had to pay? Over 622 million Zimbabwean dollars that you had to pay just to get $1 US. And so after a while, government says this just doesn't really make any sense, so how could you really plan in such an environment where by the minute your currency is devaluing? You can't. And so there's like so much uncertainty in an environment like that. And so that is why it's so important to ensure that we have low and stable inflation in our economy.
That's what a lot of my Zimbabwean friends would say. I am a millionaire back home.
Yeah. So now we're going to go into addressing Roderick's question. How can we curb the high inflationary environment? And so monetary and fiscal policies play key roles in this whole process. So the central bank, they are the owners of monetary policy. So they formulate it and they implement it. And their mandate is to maintain price stability. And so that is why you more hear the central bank speaking about inflation and not so much the government, because that's not really the government's direct responsibility. It's not, it's the central bank, and actually the central bank is supposed to be autonomous of government influence. And so you can't really have too much government influence directly into monetary policy decisions. And so what we have seen the Bank of Canada, they have done recently is that they would have aggressively increased the interest rate, because interest rate is the main tool through which to influence inflation. And we're going to see that later on in the presentation. And so the expectation is that the Bank of Canada will continue to aggressively increase interest rates so that it filters through the economy and result in lower and stable inflation. It will not happen overnight. It's a process, because there is actually a lag relationship in terms of interest rate changes and how it feeds through the economy. And it's very important to note that interest rate feeds through the economy, the impact feeds through the economy through the financial system. And so...
Sorry, okay. And for those people who may know what interest is, but in this regard, if you could just give a little bit of clarification on that.
Okay, so interest rate refers to just the cost of borrowing money. So high interest rate means that the cost for you to go and borrow money from the bank, it's going to be much higher for you. For your credit card, it's going to go higher. Any loan you have, if it's not fixed, if it's not a fixed rate loan, the cost is going to be higher. Your mortgage, if it's variable rate, it's going to be much higher. And that also impacts businesses, because businesses take loans finance, their operations. And so that will also impact them. So for example, if you had like say a business had an appetite just to take like make a $1,000 monthly payment on their loan, and but then when the loan ends, it's much higher. They won't be able to borrow as much before as they did when the interest rate was lower. And so that is actually going to curtail their spending as well. And that will filter through and impact inflation. So this chart here, it captures the monetary transmission mechanism. So the monetary transmission mechanism is simply how interest rate feeds through the economy. So here you have the central bank increasing their interest rates. And one thing is very important to note is that interest rates in an economy, they move up. They move up together, they move down together. So they're always moving together. No matter what the product is, interest rates are always moving in the same direction. You'll never ever see where interest rates in one area moves up and it moves down in another area. Unless the only thing is that interest rates will move up on something that's variable rate, but it stays fixed. If it's a fixed rate, then you'd have locked that in. But if say for instance, you have a mortgage and it was fixed rate, you got it at a fixed rate, and then it comes due, say this year, you can expect that the rate is actually going to be higher. So here you have market interest rates, which is like your short-term lending rates. So those go up, asset prices. So what happens here is that, for example, with bonds, equities, all asset prices, there's an inverse relationship with interest rates, because bond prices tend to go up when interest rates fall, and even with equities as well, because as I explained before, if you're a business, you may not be able to borrow as much. And so you may not be able to, what you used to produce and invest, it may not be at that same level. It may actually fall. So you'll actually have an inverse relationship, which is the opposite relationship to an increase in interest rates. All right. In terms of consumer and business confidence, well, the expectation of economic growth, well, they're going to think, because of the high high interest rate environment, which impacts ability to borrow in an economy, then people are going to expect economic growth to slow down. And in terms of the exchange rate, well, you're actually expecting that, well, the cost of borrowing is going to go up, but then because of the expected impact on your inflationary environment, you're going to expect that your currency is going to appreciate. So the Canadian currency is going to strengthen relative to the US, or say to the euro, whatever currency, based on whatever dynamics we're seeing in the market. All right. And so you can see here where everything, it impacts your domestic demand, and then you have aggregate demand. So aggregate demand refers to all of the demand within your economy, all of the spending within your economy, and any external demand, which is really coming from outside. For example, like your exports, then you're going to expect to see that, a decline also. And then the overall impact is that you're going to end up with lower inflation. That's going to lead to more stability in prices. And once you have a stable environment where businesses are able to predict and know, well, the price isn't going to change every minute, or it's going to change. I don't know how much it's going to change next month or the next 3 months, So if they're able to, and comfortably able to predict, then they'll be able to invest. So that is why it is important for us to reach this point of price stability within the economy. So that's where the central bank comes in, because once the central bank increases interest rates in the economy, you know what's going to happen apart from the in terms of the cost of borrowing, but then it's called a contractionary in terms of the monetary supply. So the contractionary impact on money supply. So guess what's going to happen? I have some money and I'm like, okay, well, I can go and put it in the bank now because I'm going to get a higher return. So instead of taking that money and going to spend it, I'm going to put it and I'm going to save it and I'm going to invest it. So that money is no longer within the financial system to chase those too few goods. And so that's what we call a contractionary monetary policy, or when you also hear the reference to quantitative tightening. So quantitative easing is the opposite, where they're actually injecting more money in the economy. But now when they're contracting and through contracting, implementing contractionary monetary policy through higher interest rate, they're taking away money from out of the economy, because that money is going to be placed in investments, in savings account, wherever. And so so that will end up with less pressure on in terms of prices within the economy. I hope that is clear. Anybody has any question on that?
Questions, please bring them one and all to Nadine Thompson. Yes, we're definitely getting an education this morning, 100%. And if it seems a little bit wow, like, it just definitely ask the questions. There's no such thing as a dumb question. The
Yes.
only thing dumb is not asking it. So please do ask the question so that we do understand.
Yes, and that's the objective, to try to help individuals within our community to understand inflation, get a better understanding of inflation, so that we can make better decisions and not be overwhelmed by all that we're seeing in the news. So the last thing in terms of policy, how does the government play an impact in helping to reduce inflation in the economy? Well, government, they either spend or they collect money through taxes. And so another way for them to reduce the amount of money that's there in circulation within the economy is to reduce their spending on, it could be actually like capital expenditure. For example, they decided that this year they were going to build some bridges in, say, Markham, or they're going to build a new hospital in downtown Toronto. Then they may decide that they're not going to do it this year. They may delay that spending. So that spending doesn't go into because one thing we have to remember is that once money is spent, it doesn't stay one place, but it moves around. And that's why you have a multiplier effect in the economy. So the money grows. So I spend it, then whoever I spend it with, they spend it with somebody else. And it just permeates throughout the economy, and it also grows. And so if government, they're able to curtail their spending, then that will also help to reduce the pressure on inflation. Another way is that increase taxes, so and then they could choose to increase taxes on maybe some businesses. Because right now, in a very high inflationary environment, it would not make sense for government to increase taxes on whole household. Can you imagine they increase your income tax? It's like, yes, so just think about that. So yes, so in this case, government would make the decision of what area within the economy can really absorb higher taxes now. And so it could be like, maybe an oil company. It could be an oil company, some other company that benefited or has been benefiting. So it could be that. So that's the role that government plays. And so once they implement contractionary fiscal policies, then that will also have a multiplier effect in the economy and help indirectly to result in lower and stable inflation.
Yeah. So a question from the chat. So does the government have an active plan right now to reduce inflation as the lower class are not able to afford obviously the higher prices of food and just the cost of living? Is that in the works as of now?
Well, so the government, they would have presented their budget, and they would have indicated that they would be spending, like, for example, I think childcare, more so in terms of things to benefit. So to me, it comes across as more increased spending. I didn't really pay attention to all the things in the budget, so I can't really fully answer that question. So they may actually be increasing spending in one area, but then they may also be reducing spending in another area. And so in terms of the net effect, it can actually result in an overall reduction in their spending. So I haven't analyzed the government's budget, federally or provincially, to really give you that definitive answer.
All right, another question. So in the new startup business, what are the pros and cons, the CPI inflation, or I guess the CPI to businesses, various industries like hospitality? Would it be feasible to do core planning, especially in this uncertain economy?
I would say that as a business, you always have to plan. And whether it's a high inflationary environment or a low inflationary environment, you have to always plan. But then in terms of the high inflationary environment, you have to plan in a way so that one, because cost is so important, because your cost of doing business is much higher now than before. And so you have to see, for example, how is it that you are able to reduce your costs, ways in which you can reduce your costs and increase your revenue. And the other thing is that I would encourage you to keep abreast in terms of what's going on, especially from the Bank of Canada, because they usually, when they have their monetary policy meeting and they have their press briefing, they always give an outlook. And so the expectation for now is that inflation is going to be here for a bit, but then it may not be based on the aggressive nature within which they're approaching the high inflationary environment. The expectation is that we should see some lower prices in the economy. The pace at which we should see lower prices in the economy, I can't say that. But then the Bank of Canada's inflation forecast would be a good indicator to watch. And yeah, so I hope I answer your question. But you can find like an advantageous position. For example, now, for example, say for instance, it's services. Say you're in like something that's very touristy. And now that it's the summertime, and all of these restrictions have been eased, people are now who they had saved their money before, and they weren't able to spend it. Now they will be able to spend it. You can really benefit from that environment, a high inflationary environment, if you're providing a service where these people can actually buy from you. But in terms of navigating it, it's very, you have to try to ensure that you are keeping your costs low and trying to optimize your revenue opportunities.
Okay, couple more questions. So would increasing oil production in Canada help reduce the price of gas here within this country?
You think so? It should. Any increase in supply, but then when you increase the production, it's also the oil has to be refined. And I don't think Canada really does much of the refinery here. And so it has to go back and then, come back. But then any increase to the global supply of oil would result in some reduction.
Right.
I should note any notable increase that can really make a dent in the tightness that we're seeing now.
Okay. So here's a question. So if the consumers were to say, like, let's use gas for an example. If we were to say we're going to boycott one of the major multinational gas companies, right? And use just one of the others, wouldn't then they ultimately have to contract in terms of the price of their product, lower it so that they could be competitive, and then the public basically are able to drive the costs of, I mean, not particularly, but if one is getting pain and the other one is getting gain, the other one is ultimately going to drop your price. No, isn't that feasible?
Well, we're price takers in this environment, and if I don't know in terms of the impact that a boycott from a number of consumers would have on any one of these producers. It would have to be like, I think it would have to be something really heavy-handed coming from a very influential source like government, right? Government implementing some policies that would influence their decision. And then you have the issue of, okay, how can government influence? Government is actually interfering with the free market. So you'll have people coming and arguing against that. So I don't know how that
well, it's like saying, like, if you've got mangoes and I've got mangoes, and there's a movement that says, you know what, I'm not going to buy Roderick's mangoes, I'm just going to buy Nadine's mangoes, right? I'm a mango producer. Now, if we're selling a mango at $10 each, and I'm seeing my mangoes aren't getting bought, and I say, you know what, I'm going to drop my mangoes down to $8 so that I can bring back the people. And obviously, based on my $8 mangoes versus your $10 mangoes, I can still help manipulate that price, because ultimately I'm going to want my mangoes sold, and so will you.
I would say more so companies would have a greater influence on that, Roderick. For example, like your Enbridge, your Shell, and all of those producers, then they get oil from, because they're getting oil from all these different oil producing countries.
Right.
And they would have a greater impact if they decided that they were going to boycott. Take, for instance, the whole case with Russia, and you had Shell and I don't remember who else they pulled out from Russia. So those companies have impact. They have more powerful impact than us as consumers, because as consumers, we're more price takers than anything. We're not price makers. And we don't really have that much influence in the space, unless it is actually, for example, you see cases where like the demand across like the globe, or for a particular product, or even say in Canada, the demand for oil across Canada just declines, then that could actually influence some downward movement, because then bringing us back to that demand and supply chart, you're actually seeing a reduction in demand, and then you have supply. So with a reduction in demand, you're actually seeing the demand curve moving towards your left, and then that's going to lead to prices going back down. But only if we had like a true the decline
Global
in
movement. So
and
nobody use gas for a week, and then we'll see it go down.
Yeah, something like that.
All right. Couple other questions here in the chat. So inflation is high in regards to savings. What would be the best option to save money in order to get higher rates?
I'm not an investment advisor, so please, I'm not able to give you that advice. So I'd recommend that you speak with an investment advisor.
All right.
But one thing always appreciates, like, investment in like properties, if you're able to do that. If you do like stock investment, you'd have to analyze the company and see which company has that growth potential. They're able to benefit during this high inflationary environment and continue to grow. That I would suggest that as well. But I strongly advise that you speak to an investment advisor.
All right. So based on that question, like for instance, homes right now, the cost to build a home, the cost of lumber, are soaring. So would you recommend that, for instance, somebody who's waiting to get into the housing market or to buy a home, would they wait until inflation comes down by a couple points, or is it like no time like the present?
All right. So I'm gonna use my experience. So my family and I, we migrated here in 2016 from Jamaica. And when we came, the house prices was really very bad. And I'm like, I was telling my husband, like, for those board houses, huh? The price so high, And I was like, no, we're not gonna buy houses right now because I don't think it's really worth it. And from the perspective of an economist, I'm like, this is untenable. So I don't expect that it would actually continue. Luckily, there were some policy actions. You had that stress testing that was introduced and all of those other things that the government introduced. And then we saw where house prices went down and we were able to go in the market. So my advice to you is right now, the expectation is that inflation should come down given the monetary policy actions of the central bank. And so that should feed into lower lumber prices. But Roderick, if we have that supply chain issue, you don't have people to work, then that may actually slow the pace at which the price of lumber comes down. Yeah. But if you have like other factors, like a combination of factors, for example, say you have high interest rate, so now a lot of people aren't really, inclined or incentivized to borrow mortgages, especially if they're not able to afford it. And so that's going to actually result in lower pressure on house prices. And so you should see prices actually going down. And so that with like other factors, if you see like the government introducing new, like even with the I think it was 15% tax on the foreign buyers, that should also influence a downward pressure on house prices. So I'd say take all of those variables into consideration and assess. And if I were in the position where I'm looking to purchase another property, I would wait. That would be my advice. But I am not an investment advisor, so that's just my personal.
So is it a myth or is it reality that there's not as many people who want to work? Because you would think in an economy where inflation is high that you would have to work or people would want to work. Is that something that is just being fed in terms of not having enough people to do the work? Because again, if you've been out from the pandemic and the opportunity then presents itself to get back into the workforce to make money, wouldn't that make more sense? Or is that just something that is being fed to us that we're just made to believe, and it's almost like as they say, a plaster in Barbados to just to ease over everybody in the sense of justifying these prices?
I don't think it's a myth. I think one of the benefits that came from COVID is that people realize their power. People realize what they were capable of. People realize that, well, one source of income not going to cut it. And so you have people who have explored other options, and some who decide that, okay, well, those conditions that I was working under weren't so great, and this is so much better. So they just don't go back. So that's actually a true problem. And I'm not sure in terms of how COVID impacted the supply of labor, in terms of like, because some people would have like, unfortunately died, and others, got so ill that they're not able to go back into the labor force. I'm not sure of that number, but what I'm actually seeing now is that employers are really trying to attract labor. That's why you have like RBC coming up with that increase in salary, and I think it was TD was the first one. So that's a true problem that they're facing, especially if people didn't like their jobs in the first place.
All right. Okay, another question here. So what of when the opposite is true? Okay. Why don't we see the cost of goods and services reduce at the same rate?
As what?
Why do they only throw us a sale? Okay, basically the standard prices don't really fall. Why is that? So I guess from what I'm understanding from the questions, the standard price to do something don't fall, but the cost is inflated or increased. So I'm assuming, the person might not have heard what you were saying in terms of, like, for instance, the gas prices, the things that impact the actual cost of making the goods have obviously increased. So they've got to increase their base price also, from what I'm understanding. If the person wants to clarify that.
Yeah, but I hope what I'm gonna say helps as well. So prices tend to go up quickly in an economy, but for it to go the opposite way, it's very sticky downwards. Because who wants to really give up on like a good profit margin? And then the other thing about it is you also have, in addition to like having a really favorable profit margin, you also have to plan for potential. It's like whatever profits you're earning, they help to provide a buffer and cushion for any further like uncertainties, like higher prices, because as we know, prices increase over time. There might be some issue that emerges that will actually affect the supply chain again, or the inputs that you use. And so as a company, you would want to ensure that you have that cushion. And so you can understand why prices tend not to, like, companies are not so inclined to reduce their prices so quickly, because it could be based on what they're seeing and their plans are. So yeah, if that's what your question, if my answer answers your question, then that was great.
Yeah, that's what she was asking, I guess. Yeah.
Okay.
Any more questions for Nadine Thompson? Very, very interesting topic today. And I mean, it impacts us all in some fashion or form. So please do ask your questions. And yeah, I mean, I guess it's inevitable that we have inflation. If you think about just housing in general, for instance, that has never gone down from what I can see. So it'd be interesting to see what happens within the next couple of, and I guess for anything to change or to have some sense of contraction, what is the timeline like that? Like, for instance, and this is a hypothetical, for the price of oil, when could we as consumers hypothetically see a decrease in the cost just based on the I guess, the intervention of the central bank and whatnot, or the Bank of Canada.
Okay, so that's next week's presentation.
All right, well, you see
Yeah,
that?
because now we're going to say, okay, how can we best navigate it now? Because with the central, because there is a lag effect in terms of when monetary policy, how it permeates, the time it takes to filter through the economy, and then you see that desired outcome that the central bank is targeting. So we will go into that and then build some more.
Right. All right. So a question I have. So, like, for instance, the cost of gas. Again, this is something that is impacting us all. And, some of the multinational conglomerates may be buying gas from Russia, and it's making its way, to Canada or North America, just based on their buying, who they buy from, right? So, do these multinationals now look at different markets to buy from, just based on, say, the tension that's happening in Russia? Would they look to Venezuela, hypothetically, or look to other oil-producing countries to be able to make the price of their product more affordable?
You would think so. So similar to any business, you don't have like your risk concentrated in one supplier, because you can have supply disruption due to some political, some warfare, whatever. So that's why you have these companies that they're like everywhere, like. And so, for example, with I believe it was Shell who pulled out from Russia, then you'd expect that they would be ramping up operations in the other areas or other countries that they operate, if they're able to do that. I don't know. I don't know if there must be in Venezuela. I don't know what's the but the in terms of the arrangement there, but I would expect that they would seek alternative in an environment like this.
Right.
Yes.
So some people are alluding to greed as the driver and pusher of inflation here in the chat. And yeah, I mean, I guess there is a certain amount of profitability that companies have at the end of the day, because that's why people get into business in the first place, is to make money.
Yeah, I see Keen on you saying, don't wait to buy real estate and wait. Well, if you're an investor and you're just investing in real estate properties, that's good. But then for somebody who is looking to buy real estate for their home, they have to think about, can I afford this? With the high interest rate, high inflationary environment, am I able to afford it right now? And if I buy it now, can I really live? It's like I'm always going to have to be squeezing. So I think people have to do their personal assessment, but I'm not an investment advisor. So, but that would be my perspective on it, especially if it's not like a second property for me. Like my first property, I have to think about whether I can afford it and can I live, So, yeah.
So the dollar, and I'll use the Canadian dollar as an example, versus the US dollar. Does inflation determine the value of our dollar? How does that work?
Inflation influences the value of your currency because, one, the cost of your goods determines how competitive you are. The cost of your inputs also determine the GDP, because if you think about the exchange rate is also a price. So it's a price that really reflects the quality of your economy, how healthy it is, how well it's growing. If your economy is growing, then your exchange rate is going to appreciate. It's going to get your currency is going to get stronger. And relative to, say, for instance, relative to the US, is assuming the US is not growing as fast as Canada, then you can expect that the Canadian dollar is going to be much stronger than the US. I mean, grow. It might not necessarily go one-to-one, but it's going to actually, the rate of growth is actually going to be stronger relative to the US. And so if inflation, remember, as we discussed, inflation impacts investments in your economy. And so if you're not able to invest as much, that will slow the growth in your economy. And if inflation is not controlled, then it can actually influence a negative outlook on your economy. And so people, like even domestic investors, they may not want to continue to invest, or they may wait. And so you may not see that growth in your investment. And that would actually feed into your exchange rate. And just coming back to the whole point that when your exchange rate depreciates and you export, your goods on the international market is going to be much more expensive relative to your competitors. And so whatever you're able to bring back into your economy to help it grow, it's going to be less because your goods are not really selling.
So that's what's happened in the Caribbean, I guess.
Yes.
To a great degree with some of the countries that inflation is just like ran away, and you're paying whatever, thousands of dollars in that local currency for something that cost here in North America, maybe $1 or $2, right?
Yes. There is actually a measure of like your international competitiveness, which is called your real effective exchange rate. That's just another thing, but that's really the measure that countries look at to see how competitive they are to their other trading partners. So, yeah.
So where is the standard set in that regard? Because there has to be a standard. There has to be a measurement tool that can establish, how competent is my economy versus your economy. What is that standard based on?
The standard, it comes back to your monetary policies, because at the end of the day, the role of the central bank is to ensure that you have an economy that fosters economic growth. So you have the macroeconomic goals, which is low unemployment, you have stable prices, and you have growth, economic growth, low prices, and you have low unemployment. All right. And so it comes back to those monetary policy targets as well as the fiscal policy targets of a country, because it's not another country's business to try to make your country grow. So it's actually based on those targets that are set by the respective authorities within each country. So I'd say that's like the standard, or that's the benchmark that they use as their guiding post to influence their policy decisions.
Okay.
Yeah. And just for example, just look at the inflation target. Most countries target an inflation rate of 2% because they believe, based on research, that has shown that a rate of inflation equal to 2% is good. That's like the optimal level to be at. And so that is what is target. So that's like the benchmark. So at that level, your country will grow, it will remain competitive, it's good, standard of living will grow, and things will be airy and nice. So yeah.
Right. So does the interest rate and the inflation rate, ideally they almost sound pretty neck to neck, right? Is that correct?
Yes, they go hand in hand. Because interest rate influences inflation in your economy. Okay. And based on inflation in your economy, so I should say interest rate is a tool that's used to control inflation in your economy.
Right.
You see it going away. Say, for instance, you have like, I'm gonna just use it. You have say a dog, and you go walking the dog, and you give him a long leash, and you see him run down, and you're like, you just pull him back a little, So that's what interest rate does. Keeps inflation in check.
So in this case, with our global economy right now, or even in North America, it sounds like the interest rates didn't keep up with the inflation rates.
And that's one of the arguments you hear people put forward. They're saying that the central banks have been too slow in their response to the high inflation environment. So yeah. And now they're like, trying to catch up. And so that's why, for example, in the past, you'd see where the central banks, they increase interest rates by 25 basis points. Now they're going for 50. And I know people, there was this argument about, a 75 basis point, but I think that's shelved because that would be too aggressive. So that's also very important. It is so sensitive where the central bank, the rate at which they increase interest rate is so important. It can't be too aggressive and it cannot be too passive. So yeah, because
obviously what the central bank in terms of the interest rates, that's what the banks, if I'm correct, will get. Like if it's say 3.5 hypothetically, but then the banks will obviously increase that to the consumer, so we may be paying 5.5. Yes,
and that's why I had said earlier that monetary policy, it works through the financial system. So once the interest rate goes up, then the banks, they're going to actually pay more money to borrow. Because remember, banks are borrowing money to lend you. It's not like the banks really have all this money that they're lending. It's not really their money. So they have to pay for it. But then while paying for it, they are also making a margin. So they have to make a margin too. So, but anyway, whatever cost they increased costs that they face, they're going to pass it on. If not all of it, then a portion.
So ultimately, the big banks are borrowing from where then? If they don't have that, from the not central bank.
They borrow from everywhere.
Okay.
They borrow from each other. They borrow from they borrow internationally. They have different. So you have like what you call like the money market, and then you have like the capital markets. So you have the money market is where you have short-term money, short-term loans. So it's up to like a year. The capital market is a year and long-term money. For example, the capital markets where they like issue like bonds to raise money. Money markets, they like issue like commercial papers to get money, and they can also raise unsecured funding where they don't have to collateralize that money. But then they also use deposits, because remember, that's how banking all started, where they're just putting borrowers and lenders together. So they use the deposits and they are lending it to create loans, mortgages. But then based on the demand for all of these loans, the deposits might not necessarily be adequate to meet all of those loans. And so that's why financial institutions, they will go and raise money through different sources.
All right, we're getting deeper, folks. And it is actually that time where we say thank you very much for joining us for another week. Nadine Thompson, it's been a pleasure. And I'm just like myself, I'm sure everybody who's on here has learned something they didn't know. And thank you very much for sharing your insight and your experience and your wisdom with us. And we look forward to next week and increasing our knowledge in terms of economies and how they work. And definitely today, we've all learned a lot more than we did probably coming in about inflation and how that actually works in this place that we call an economy. So thank you very much. It was a pleasure, and we definitely look forward to seeing you next week.
Thank you very much for having me as well. And I really hope that each person on this call found it very beneficial. You learned something, could have been something you learned before, but it's like a refresher. And so, yeah. And I think someone is asking for the presentation. I can actually make it available to
and the BBPA does have them online on our YouTube channel. So I don't have that right here off the bat, but if Victoria, if you've got that, you could join us. Sorry, you could put that in the chat. And definitely next week, if you join us back, I will have that for you in the chat so you can go back and review the different sessions over the past few weeks. All right, so on that note, we're going to say see you later, au revoir, and we will see you back here at 10 a.m. Eastern Standard Time, same place, here on Community Space. Thank you very much. Take care, stay safe.
Bye.
Bye. Community Spaces, the financial literacy program that speaks and reaches the community. Are we going to be in a better place, or are we going to be still, quote unquote, behind the 8 ball?
Because of the historical disadvantage that our community has, we most times do not have financial role models. Without that, economically and financially speaking, we'll always be at the bottom.
Keep proper books and record, because the data drives the strategy, and the strategy drives the profits.
COVID-19 sort of removed a veil. It's really exposed the structural barriers that our communities face.
These last 2 years, where there's been a heightened emphasis on the well-being of Black people, has influenced the influx of funds and opportunities. The time is now. How long is that window going to be open?
We'll see you next week, and don't forget to tell a friend to join us here on Community Space